Hey everyone, welcome back to Intermediate Financial Accounting 1. In this class, we're going to talk about the accounting information system. Specifically, we're going to first have a brief review of some basic accounting terminologies. And then we're going to go over the 10-step accounting processing cycle. And then after that, we're going to use a comprehensive example to illustrate those 10 steps. So first of all, review of the basic accounting terminologies. Cash accounting and accrual accounting, what is the difference? So both cash accounting and accrual accounting, those are ways to do accounting. So those are two different accounting systems. For cash accounting, it is mostly we do accounting based on cash receipt and payment. Versus for accrual accounting, we do accounting based on the occurrence of economic event. So the occurrence of economic event does not really need to be at the same time as cash receipt and payment. If a firm makes a sale, sometimes it may ask its customer to pay in advance. Sometimes it may allow its customer to pay later. So according to cash accounting, we only record revenue when the firm is receiving cash. But according to accrual accounting, we don't record revenue when the cash was received, but we need to record revenue when sales is made. Regarding the accrual accounting for revenue recognition, we're going to talk about it later in the class. But the point here is, under those two systems, the time we record revenue will be different. They may be happening, so depending on when cash receipt and payment happen, which relate to the occurrence of economic event, the time we record revenue may be different under these two systems. And then which one do you think is considered a better indicator of future cash flow of the firm? Yeah, that is actually accrual accounting. So that is one of the pros of accrual accounting. It is considered the accounting numbers generated under accrual accounting is considered a better indicator of a firm's future cash flows. However, accrual accounting also have its drawback. The major drawback of accrual accounting is the fact that accrual accounting inevitably involve estimates. So it's not like cash accounting. And if a firm is doing accounting based on cash receipt and payment, those are fact. So there's no estimation needed here. Whenever a firm is receiving cash, it can record it as income. Whenever the firm is paying out cash, it can record it as expense. Versus for accrual accounting, but because it is not doing accounting based on cash receipt and payment, it is doing accounting based on the occurrence of economic event. So there must be some, there is a lot of estimates involved in accrual accounting. And with regard to estimate, so when accounting is done, which involves estimate, inevitably, there are lots of subjective part in it. So it can be subjective. And what is the problem with subjective? There are two problems with subjectivity here. The first one is it may involve estimation errors, so which are probably unintentional. So firms may make some unintentional estimation errors because estimate is estimate. we cannot count it to always be 100% accurate. So estimate is only an estimation of what may happen in the future. It just cannot be, even though the firm is not intentional, firms are unintentional, but it just cannot be 100% accurate. So estimation error. And the second one is firms may intentionally, so it may be subject to management manipulation. This is the firms may intentionally kind of manipulate it. And then to manipulate those estimates, the firm may eventually be able to manipulate the firm's earnings. So subject to management manipulation. So let's look at an example here. Carter Company makes sales totaling 100,000 per year for 3 years. So this is the sales the firm made, which is the occurrence of economic event. However, the amount of cash, sales made in cash were 50,000 in the first year, 125,000 in second and third year. So as you can see here, that 50,000 sales made in the first year was kind of postponed to the next 2 years. The company used cash to repay 60,000 for 3 years rent in the first year. So all of the rents were paid in the first year. Utilities are 10,000 per year, but in the first year, 5,000 were paid in cash. In the second year, 15,000 were paid in cash. And on the third year, 10,000 were paid in cash. So even though utilities are 10,000 per year, but those utilities are paid at different times. In the first year, only half were paid. And then in another half of the first year was postponed to be paid in the second year. Salaries are paid in cash every year at 50,000. So which of the following two methods measure Carter's performance using accrual accounting? So I have two ways to do. This is what happened with the firm. And then here are two ways to do accounting. The method one, so you can take a look at this. And then method two. Can you tell me which one is using accrual accounting? Is it method one or method two? If you need more time, you can pause your video for now. So method one. And method two. So method one is using accrual accounting versus method two is using accrual accounting and method one is using cash accounting. Why? Because method one, so all the sales and all of the expense, those are recorded based on when cash is paid and when cash is received. So that is the way we do cash accounting. Whenever we receive cash, 50,000, even though the firm is making 100,000 cash, 100,000 sale in the first year, but because it only received 50,000, so it just record 50,000. And then even though the rent each year is 20,000, but because it is all paid out in the first year, so the firm needs to record 60,000 cash payment in the first year. So it is all based on cash receipt and payment. Versus the second method, it is recording revenue based on the occurrence of economic event. What is the economic event here? The economic event is the sale of the good. So whenever the firm sells the good, we're going to talk more about it later when we talk about revenue recognition. But when some certain criteria is met, then we can record revenue. So it is based on economic event. And also here, rent expense. So the firm is renting for 3 years, each year 20,000. It doesn't matter when those cash were paid. What matters is the occurrence of economic event, which is the firm is renting the property. So as you can see here, the net cash flow, if we are using cash accounting, the net cash flow is negative 65,000 in first year. Why? Because of the 60,000 mostly, right? And also because some of those cash sales is like kind of the cash was received in the second year. So in the first year, we have negative 65,000. In second year, 60,000. In last year, 65,000. Is it stable? No, it's not stable. So can those information really help us if we want to forecast the future net cash flow of the firm? Can we really use those numbers? Not really. There's not a lot of information here because of the fluctuation in the timing of those cash receipt and payment. So we cannot really, it's not really giving us a lot of information here. Versus here under accrual accounting, the net income is 20,000 each year. So that's why, as you can see here, that net income produced by method 2, which is under accrual accounting, better reflect the true economic activity of the firm than net cash flow produced by method 1. And then because it better reflects the true economic activity of the firm, so it is a better indicator of the firm's future cash flows. So it is more informative if we want to forecast a firm's future cash flow, the future cash flow of the firm. So that is cash accounting and accrual accounting. And then what is the basic accounting equation? This you should learn in your introduction to accounting class. What is the basic accounting equation? The basic accounting equation, what is that equation? So the basic accounting equation is basically assets equals to liabilities plus shareholders' equity. So what is assets? Assets represent total economic resource of an entity. What we have, what economic resource we have. Liability and shareholders' equity represent total claim against an entity. So liability represent claim from its debt holders, and shareholders' equity represent claim from its stockholders. And for shareholders' equity, it can be decomposed into 2 parts. The first part is PIC, paid-in capital. And the second part is retained earning. So paid-in capital is basically the amount invested by shareholders, and retained earning, that is the amount earned by the corporation. So using the amount invested by shareholders, how much the corporation earned. And retained earning, it is also the sum of all of the firm's net income minus dividend from the beginning of the firm. So from the firm's inception, the sum of all of firm's net income minus dividend. That is since the inception of the firm. And what can net income be decomposed to? Net income, that is net income, that is a flow idea. So each year, at the end of the financial reporting, financial year end, the firm needs to close its book, and then the net income will be closed into retained earning. Then at the beginning of next period, we're going to start calculate net income starting from 0. So, but net income every period, it is revenue minus expense plus gains minus losses. So, and this is for every period. So since the inception of the firm, or in other words, retained earning is since the inception of the firm, every period, revenue minus expense plus gains minus losses, and then minus dividend. And then for next period, if the firm move on to the next year, we need to add revenue minus expense plus gains minus losses to that again, and minus the dividend of the second year. So that is a stock idea since the inception of the firm. It's a cumulative number. So that is the basic accounting equation.